right, so like I said, in the appendix, the only thing I'm going to cover in the appendix is the the savings bond interest exclusion. So savings bonds, again, these are issued by the federal government. There are a couple of different types of savings bonds that this applies to, Series EE or Series I savings bonds. So the interest income is not taxable once the bond is redeemed, as long as the proceeds, and it would be all of the proceeds, not just the interest, but also the principal, as long as the proceeds are used to pay higher qualified higher education expenses. And that would be for themselves, for their spouse, or for any of the dependents that are on the tax return. They must have been purchased after 1989 by an individual who is at least 24 years old at the time of purchase, who is the sole owner or joint with the spouse, joint owner of the bond. So it can't be that, like grandma bought it and it's got grandma's name and the grandchild's name on it. That doesn't count. But there has to be a sole owner or married filing joint owners. So it goes through and talks about what higher education expenses are. So tuition and fees at a qualified educational institution. The taxpayer has to first reduce their expenses by any scholarships that they receive. So if they receive scholarships, they subtract that amount to determine how much of their savings bond interest is not taxable. Also, certain educational assistance allowances and benefits under a state tuition program. So married persons living together have to file a joint return in the year of the exclusion. There are also limits on your income, how much income you can have and receive this exclusion. They can exclude the full amount of interest subject to a phase out. So this term phase out, you'll see this a lot. We have these phase outs. So it means you get the benefit as long as your AGI is below a certain amount. But and then there's a range of income where you're going to get part of a benefit until it phases out and you get no benefit. So usually these phase outs, there's a range where you're going to get a partial benefit. So subject to phase out only if the amount of qualified higher education expense paid in a year exceeds the redemption proceeds. So that's principal plus interest. So all of it, not just the interest part, but the principal as well. If the proceeds exceed the expenses, the amount of interest that's excludable is limited to the interest times a fraction of, they go through how to do that calculation. So they got an example here. Angelina and Albert redeemed $4,000, principal of $3,000, interest of $1,000 of Series I savings bonds. They did that in order to pay for qualified higher education expenses. Expenses for the year totaled $3,500. Well, so you see the expenses are $3,500, but they redeemed $4,000. That means not all of that interest is going to be excluded from taxability. They can exclude, and the proportion of that is the $3,500, the amount of expenses divided by the amount that was redeemed times the interest, because this is the amount that would be taxable, the $1,000. That's how much interest they earned. So we're trying to determine how much of that interest is taxable to them, because they used most of their bond proceeds for higher education, but not all of them, right? So the most that they could exclude from income is $875. That means the remaining $125 is going to be taxable to them, okay? Phase out amounts. So if you're, and they say modified AGI here, whenever you see the word modified, it means we're going to start with AGI and then we're going to add something back or add something onto it. In most cases, we don't have to really modify it because they're kind of obscure items that we have to add back, but that's what that means. So the modified AGI of the taxpayer for the tax year, if it exceeds $145,200 for a married filing joint return, So that's when the phase out starts. Or for married filing joint, $96,800 on all other returns, all other filing statuses. So how you figure this out is you take the amount that was otherwise excludable, like in this case, they would have been able to exclude $875 if we're determining what their phase out is. So the first step in doing this is to determine, based on how much of the bond proceeds, how much of that was used toward higher education expenses. Okay, if 100% of it was used toward higher education expenses, and that's interest and principal, then 100% of the interest would be otherwise excludable. That's the amount that you would list here. Then we take the modified AGI minus the limitation amount. Where's our limitation amount? Oh, the amount that what is our limitation amount here? Let's look at this example because I'm drawing a blank here. 96.8. Oh, their modified AGI minus the limits here. Sorry, divided by either 30,000 if you're married filing jointly or 15,000 if you're single. What this means is once AGI reaches 175,200 for married filing jointly, it doesn't matter if you used all of those proceeds for higher education. None of that is going to be, you're not going to be able to exclude any of it. So you lose this is a great example of why AGI is important. So once your AGI reaches that amount, you lose the ability to exclude the savings bond interest. And once it reaches 111,800 for other returns, you don't get that. You don't get the benefit. So you lose the benefit. So let's just say, so we had this information, but we don't know what their AGI was. Let's make up a scenario here and say that their AGI, well, let's make sure it's between our limitation amounts. Let's say their AGI was $160,000. This is our married filing jointly couple here, Angeline and Albert. Now, we're going to take the amount, they did the math here for us, what's otherwise excludable. So we'll take the $875 and we're going to multiply that by this proportion. So we'll take the modified AGI, 160, minus our lower limitation amount, 145,200. Okay, and we're going to divide it by, they're married filing jointly, so we're going to divide it by 30,000. You're going to see this type of calculation several times, okay, because there are a lot of phase outs. This is the phase out calculation. So, come on. 160 minus 145.2. 14,800 divided by 30. 0.4933 times 875. 432. So that's the amount we can exclude. We can't exclude any more than that, even though otherwise we would have been able to exclude $875 up here. Because their AGI is $160,000, they only get to exclude $432. So it's further limited. So it was limited first off by the fact that they didn't spend all the money on higher education, and then it's further limited because their AGI is too high. Right? So here's another, let's see, we've got Olga is single. So her excludable savings bond interest is $1,400 prior to any modified AGI limitation. So she did the math, what was actually excludable, $1,400 of it. Her modified AGI is $97,000 4,600. So we would take for Olga, we're going to take the 1,400 times, and this is, we're just trying to figure out the proportion here, 97,600 minus 96,800 divided by 15,000, because she's single. That's why we're using 15,000 instead of 30,000. All right. So we get $75 here. And I'm sorry, I said that backwards when I did the other one. That was the amount that we can't include. That was how much. So that $432 was the amount we would not be able to include. So the further amount, so let's see, the excludable savings bond interest for her is $1,325. So this we're going to subtract from this to get the amount that we can exclude. So this is the amount we can't exclude, sorry, $1,325 excludable, and this is not excludable. Okay, so I said that backwards with the other one. The 432, we would want to subtract that 432 from 875 to determine what they can exclude. Okay, so the 432 is what we would include on the tax return. So this one for Olga, she would report $75 of taxable student bond interest income. Okay. This is modified adjusted gross income. So again, we're starting with, so that provisional income, I don't know why they don't just call that a modified adjusted gross income, but it's the same sort of concept. So adjusted gross income, we're going to add back student loan interest, deduction for tuition and fees, which doesn't exist. I still don't understand why it's there. Savings bond interest exclusion itself, foreign income and allowances, and adoption assistance. So you can see it's a lot of the same items that we added back to AGI for our provisional income as well. Let's see. And that's it. Questions?